Assalamualaikum and hi everyone. Welcome back to my channel, and today's presentation is on group consolidation. Specifically, we are going to look at the consolidation issue relating to bonus shares issued by subsidiary. And our focus today is to look at the impact of the bonus shares issued by the subsidiary in the preparation of the consolidated statement of financial position, focusing on the bonus issue out of pre-acquisition reserve, as well as bonus issue out of post-acquisition reserve, and looking at the accounting treatment or the consolidation treatment for this bonus issue out of the different reserve balances. So I have two illustrative examples to show the accounting treatment for the bonus shares issued by subsidiary company. So let's start looking at the bonus shares. So bonus shares are actually the situation where the subsidiary or the parent can issue in addition to the existing shares that are being held by their shareholders. In our case here, it is a subsidiary company that issue bonus shares, and that can be done anytime, and the holding company's shareholding will increase proportionately, however, with no change in the controlling interest. So let's look at the case here of Set Berhad, where you have this issued and paid up capital. Set Berhad is the subsidiary company, 300,000 ordinary shares of 1 ringgit each, the fair value. So that is the before the bonus share. And subsidiary company Set has issued the shares, which is the bonus shares, in proportion of 1 for every 5 shares held out of profits. So you normally utilize the reserve to finance or to capitalize the bonus issue. So that was issued at 1 ringgit. And the proportion is 1 share for every 5 shares held. So the bonus shares would be 1 for every 5 times 300,000, which is the 300,000 ordinary shares, and that would be 60,000 shares, extra shares or additional shares. So originally the holding company holds 240,000 in this case, and therefore that is an 80% controlling interest, whereas the non-controlling interest will be having the remaining shares, which is 60,000, and that is because the ordinary shares in the subsidiary was 300,000, and that will give the percentage of 20%. The bonus shares that was issued, the 60,000 here, 80% will belong to the holding company, which gives 48,000, 80% times 60,000, and the non-controlling shareholder will be getting 60,000 times 20%. That will give them an additional shares of 12,000 free of charge. There is no cash flow movement in the issue of bonus shares. And after the bonus shares, the shareholding of the parent in terms of number of shares has increased to 288,000, and the shareholding of the non-controlling shareholder has increased to 72,000 units, or the ordinary shares. However, the percentage of control by the parent still remain the same, 80%, as well as the percentage held by the minority shareholders. The so-called non-controlling interest percentage is 20%. So the issue is, if there is a bonus shares made by the subsidiary company, what is the consolidation treatment? So the consolidation treatment will depend on the reserve that was utilized for the bonus issue. The bonus issue could be from out of the pre-acquisition reserve, which is the reserve existing on the subsidiary company on the date the shares were acquired, or it can also be out of the post-acquisition reserve. So the accounting treatment prescribed that the pre-acquisition reserve shall be utilized first if in the case of bonus shares by the subsidiary company. How much is the pre-acquisition reserve? You need to go and check what is the balance. So if the pre-acquisition reserve in our case here is the retained profit, we need to go and check what is the balances available in the retained profits of the subsidiary. if the pre-acquisition reserve balances of the subsidiary are available. Therefore, these balances will be utilized and reduced with the bonus shares, right? When do you use post-acquisition reserve? You will normally use post-acquisition reserve to finance the bonus shares if the balance that is available in the pre-acquisition balance, the reserve, which is, let's say, the retained profit here, is not enough to cover the bonus shares. So the balance not provided by the pre-acquisition reserve will be utilized out of the reserve accruing in the subsidiary company after the date the shares were acquired by the parent, meaning that after the acquisition of the control. What is the effect of the bonus issue? So in terms of the shares that are being held by the parent and the non-controlling interest, there are increases in the number of shares held. However, that does not increase the holding company or the parent's company controlling interest, as well as the non-controlling interest percentage of the minority shareholder. And at the same time, that does not change the amount of goodwill or the bargain purchase arising on the date of acquisition. So let's start by looking at the bonus issue out of by the subsidiary company out of the pre-acquisition reserve. And let me rephrase again. Bonus issue only involve book entries, and there is no flow of funds in terms of cash flow. There is no cash flow. This is because the corresponding increase in the ordinary shares is reflected by the corresponding decrease in the pre-acquisition reserve. So the impact of the bonus shares are being mentioned earlier. These are the ordinary shares. Capital of the subsidiary has increased. Pre-acquisition reserve balance will be reduced if you use pre-acquisition reserve for the bonus shares. And as I said, no impact to the goodwill. And that will increase the ordinary shares of the subsidiary in the fair value of the net asset. Remember, ordinary shares is equity and equity is net asset, and the reserve as well is an equity and there is a decrease. So at the end there is the effect is actually no effect. But in accounting wise, we need to do the consolidation adjustment. The ordinary share capital of the subsidiary after the bonus issue need to be included in the calculation of the goodwill, which is when you were calculating the fair value of the net asset on the date of acquisition. And for the holding company, only memorandum entry will be made to indicate the increase in the ordinary shares held by the holding company. And when they hold additional shares, however, the controlling interest and the non-controlling interest still remains the same. In terms of the consolidation journal, so the reserve is being decreased. So the reserve that will be reduced is the reserve of the subsidiary. So that will be debited, and the ordinary share capital will be credited. And the one that you will credit is the subsidiary because the bonus shares are issued by the subsidiary. However, if you come across bonus issue share that is being issued by the parent, so therefore the reserve that will be utilized will be that of parent, and the ordinary share capital that will increase will be that of parent in case bonus issue is also made by the parent company. But this one is focusing on bonus issue made by the subsidiary company out of pre-acquisition reserve. So illustration 1. If you look at illustration 1, you are given the separate financial statement of the two companies here, Head and Set. Set is the subsidiary, Head is the parent company. And you have the information on investment in Set, where the consideration transferred is 650,000. So this is the consideration transferred. And you are informed the ordinary shares is 300,000, the amount, and the ordinary shares of the parent company 700,000. Information that is given here, additional information, had acquired 240,000 out of the 300,000 shares. Before that, this 31st of December year 9 is the date you are going to prepare the consolidated statement of financial position, or this is the current year reporting date. So when you acquire 240,000 out of 300,000 shares, that was on the 1st of January year 8. So 1st of January year 8 is the date of acquisition, is where you get your control. And at that time, the balance in the in SAT's retained profit were 130. And this is actually the pre-acquisition balance, or pre-acquisition balance means the balance available on the date of acquisition, the retained profits. The general reserve, there is no information, so we assume general reserve balance is 0. And at the same time, if you check the general reserve under the column of SAT, there is no balance, so there is simply no general reserve. And you have the information directors of SAT declared bonus issue of 1 for every 5 shares. So for every 5 shares, you get 1 bonus shares, and the value was 1 ringgit, and it will be held out of profit. So the reserve that will be utilized is the retained profits, and that has not been recorded. And these shares, you are informed that the shareholder will not be entitled to the dividend payment that is if there is any being proposed at the end of the year. So there are no rights to the dividend. They do not rank for the dividends at the end of the year, because the date of acquisition is on 1st of January year 8, and we are talking about 31st of December year 9, the reporting date, which is after 2 years. So you are required to do the consolidation journal, calculation of goodwill, and also the schedule to compute the reserve, and also the extract statement, consolidated statement of financial position to show the impact of the consolidation. So let us look at what we have here. First, what we need to do is to draw the timeline. So when you draw the timeline, what you need to do is to plot when is the date of acquisition. So when you draw the date of acquisition is on 1st of January, year 8. So that is the date where the shares or the ordinary shares were being acquired. The year end or the current year end is 31st of December, year 9. So the pre-acquisition balance were given. There are no balance for the general reserve, but there is a balance, pre-acquisition balance, that will be the case that you are going to investigate for the bonus issue, right? Next, you have 2 years after the acquisition that you decide to do the consolidation. So the retained profit at the end of the year, if you refer to the information given, it was 170,000, and the general reserve balance is 0. So if you recall, the bonus shares that were declared was 1 for every 5, that is the proportion. And the shares held in the subsidiary is 300,000 ordinary shares. So the shares is 60,000. The fair value is 1 ringgit. So you have 60,000 ringgit. And for your information, the difference between 170,000 and 130,000 is the post-acquisition reserve. So throughout the 2 years, the increase is 40,000. So if you look at bonus issue, whether it is out of pre or out of post, first you need to go and check what is your bonus issue. It was 60,000, and then you go to and compare with the pre-acquisition balance. So our pre-acquisition balance is 130,000. So as I mentioned earlier, you need to go and check what is the pre-acquisition balance. If it is enough, you will issue the bonus share utilizing the pre-acquisition reserve, even if the question remain silent. So in our case, 40,000, and the balance is more than enough. So the pre-acquisition profits, which is the retained profit, on the date of acquisition, 1st of January year 8, will be utilized. So the bonus issue will have to be reduced before the consolidation to the retained profit on the date of acquisition, and that was 60,000. So therefore the adjusted pre-acquisition balance is 70,000. So that has to be removed. And the ordinary shares before the bonus issue was 300,000 in terms of value, and the bonus issue in terms of the amount is 60,000, and now the ordinary share capital of subsidiary after the bonus issue has increased to 360,000. So what you need to do is this has to be reflected in the calculation of the fair value of the net asset before you proceed to calculate the goodwill on consolidation or any bargain purchase. Let's look at the calculation. Before that, let's look at the bonus issue journal entry. So the same thing is that you need to go and reduce the profit. So reduce retained profit. And what you are reducing is actually the pre-acquisition profit. So they have debit retained profits, 60,000. This is a memorandum entry. And credit ordinary share capital, 60,000. This is to reduce the pre-acquisition retained profit of the subsidiary with the bonus issue. Let us look at the computation of goodwill. The consideration transfer that was from the information in the statement of financial position is 650,000. And remember, this reflects the investment in the ordinary share capital of SAT. Remember, the parent is HAT. Right. So the non-controlling interest, how do you calculate? First, this is actually no information telling you how to measure the non-controlling interest. So your assumption is that it will be measured at the proportionate share of the fair value of the net asset of the subsidiary on the date of acquisition. So you will have to calculate what is the net asset. Remember, your net asset should have considered the ordinary share capital balance after the bonus issue, and also the retained profits pre-acquisition balance after considering the bonus issue. That was deducting the 60,000 here and adding the 60,000 to the ordinary share capital, where the impact at the end, the net asset does not change. It was just some kind of reshuffling of the items under the net asset, right? So the goodwill on consolidation will be 306,000 because 430,000 is the fair value of the net asset, and that will be multiplied by 20%, the non-controlling interest percentage, which gives you 86. So if you compare this, you will get 306. There are no impairments, so you just take this to be your carrying value of the goodwill to be disclosed in this consolidated statement of financial position. So let's look at the next one, which is answer C. Answer C is to prepare the schedule. So if you were to prepare the schedule, I would suggest you to have the retained profit at one column and divide between the subsidiary and the one of the group. Group means that is being actually done by the parent HAT, and the same case for the general reserve. You can have the order anywhere you like. You can put non-controlling interest here first, as I mentioned, but here I'm putting it at the last row. First, put the non-controlling interest that was arising on the date of acquisition. Now we are going to look at the impact of the bonus issue, which will not impact the general reserve, but it will impact the retained profit of SAT, where the balance as at the statement of financial position, which is as at the end of year 9 was 170,000, but that has not been adjusted with the bonus issue, so that has to be adjusted with the bonus issue 60,000. That is where you go and debit the retained profit, and earlier the pre-acquisition balance has already been adjusted to be 70,000. So at the end, your post-acquisition balance, adjusted post-acquisition balance is 40,000. Out of this 40,000, 32,000 will be shared by the parent. 32,000 here means it is actually 40,000 times 80%, the holding percentage, and the remaining will be shared by the non-controlling interest, which is 40,000 times 20%. So that is the non-controlling interest share in the retained profit. For the general reserve, none, because the general reserve balance is just the one of the parent only. Let us look at when is the general reserve. So the balance in the general reserve is actually 300,000, and there are no adjustment in the subsidiaries column, and therefore if you see here, the there are no adjustment to the group column as well. There is only the balance that were brought forward or taken from the statement of financial position of the parent. So you will total up for the group profit it is 232 because the balance of the parent was 200 added with 32,000, the share of the parent in the post-acquisition profit of the subsidiary. And then the non-controlling interest has to be added with the one on the date of acquisition, and that gives you 94. And the group reserve will just show the balance of the parent company or the group. So next is to look at the goodwill. So the goodwill is directly from the calculation because there are no impairment. And this 700,000 is from the statement of financial position. Remember, just the one of the holding. And 232 is from the schedule here. And 300,000 is from the schedule. 94 is from the schedule as well, and the total equity at that time is 1326. This is just an extract financial statement. Okay, I've done with the first example. We'll go and look at the second example, which is going to be on bonus issue by subsidiary out of post acquisition profit in my next video, post acquisition reserve. With that, I thank you for watching and have a nice day ahead. I'll see you when I will see you.